Hey guys, what's up? How's it going? Welcome back for another video on the channel. In today's video, I'm going to be doing a bit of a deeper dive into the margin investing case study. So like I said, guys, this is going to be a series where once a month or so, just like with my regular updates, I'm going to be doing an update on my margin investing case study. And this is going to be an ongoing series, just like my other series. And the idea with this series is to show you guys how I'm doing the margin investing strategy, show you guys how this stuff works, and show you guys how to try to do this in a responsible way. In each video, we're going to kind of focus on some different aspects of margin investing, just because like regular investing, there's a lot to uncover. It's kind of one of those things that you learn and you grow as you go. And that's something I've definitely found the case with this series and whatnot. So that's what we're going to do. I'll basically kind of be doing an update, show you guys all my results and whatnot, what my game plan is. I'll show you guys how things change, and I'll talk about some different things that I learn and everything we're applying here. So this is going to be a bit of a long series like my other series, but I think it's going to be a good way to do things. And I've been having a lot of fun with it. So let me know what you guys think about it. You guys like this series. I was originally going to do one video a month and just make a big video with everything, but I do understand that there's some people who like different types of investing and whatnot. Some people aren't like more the traditional dividend investing. Some people like more margin stuff. So I wanted to separate it just because also they're very different styles of investing, as I've really found out. But it's been a nice refreshing change. So we're going to talk about that throughout this video. But yeah, I'll just give you guys a quick little update on the portfolio and let's see how things have been doing. So here's the margin account on Wealthsimple Trade. As you guys can see here, we have our non-registered margin account. I started this account by depositing $50 into the account. So that's where basically it started off. And as you guys can see, this graph is based off that $50. So this is how the account has grown. Since I put that $50 in, we are up $178. 356.74% all time. And again, that percentage is very large because remember, with margin, you're really creating money from nothing. So you're obviously going to get a higher percentage return. Whenever you invest with margin, it's not like you're putting $50 in and then you get a 10%. You literally put in $0 in, and then anything you make is going to be like cash you made, right? So it's important to remember that. So it's always going to be a pretty high percentage here. So that's just the way things are. I'm going to click here and show you guys a few things. So we'll talk about like my portfolio that I'm using as to basically base these numbers. So let's go through this really quickly here. The margin I've used so far is $3,762. That's, I think, about 2% or so of my TFSA. My goal is to hit about a 7% cap. And if markets drop, like we see a big drop in the markets, maybe we can bump that up to 10% as the market is dropping, or even after we've seen that significant drop, just so that we're extra conservative and we can also buy in on opportunities and whatnot. But the cool thing about doing this strategy is I've actually, as I found out, that by putting a little bit of money every single day, we're not even getting close to that 7%. And we do have some other things in place, like trimming our growth as we go and whatnot, which again, we'll talk about in this video. But just to let you guys know, 7% is my max that I'm going with, which is very conservative. The market would need to drop about 90% in total in order for the account to get margin called, which is basically unheard of, and it won't happen all at once. So my biggest tip for most people is to do your research on how much margin you want to use, base it off a percentage of portfolio. But I would recommend you guys, even if you're just going to start off, be very conservative, because you see a lot of people using like 20, 30, 40% margin, and there's nothing wrong with doing that, but there is risks in that. And, it might seem not too bad, but, when the markets are crashing and things are going on, that's going to take a psychological toll on yourself. So you guys have to decide for you what the right percentage number is to use. So that's 3,762 margin total in use. Our portfolio value in total is $191,000. And here's my linked TFSA, which is determining my buying power. My margin requirement from Wealthsimple is $57. This means that at all times, in order to not get margin called, my account has to stay at least above $57,000, which, is obviously quite a bit. We would have to see a crazy crash, and it'd have to be like really, really fast in order for this to cause us any problems. And because our portfolio has grown a lot and we're doing this more later on in our investing career, it gives us an opportunity to use a very low percentage of margin, but also use enough margin to actually make the dollars matter to some degree. Like it's actually going to make a bigger effect, especially as time goes on. And again, our max power, buying power is $130,000, but as I mentioned, we're not using anywhere near that. Interest rates we have right now is 4.7%. So we did see a drop in the interest rate. When I did the first video for this series, I think we were at 4.9% is what Wealthsimple was giving. giving me at the time, and they dropped it 0.25%. And I think over the next year or so, we might see a little bit more, a couple drops. We don't know yet, obviously, but that's what the prediction is. So interest rates are pretty fair, I would say. And again, we can see the accrued interest for this month has been $9, and last month we had $2.65 as well. And I'm going to be tracking the dividends and whatnot and all the gains inside the portfolio as well, which I will show you guys a spreadsheet later on in this video. The other thing I want to talk about in today's video is going to be margin trimming. So I created a milestone on basically different account values for our margin account. So when our margin account gets certain types of a certain percentage of realized gains, we're going to be trimming the portfolio back. Number one, to just get in the practice of selling, trimming the portfolio. And what this does, it allows you to kind of take your margin back, lock your gains in, see it as a actual realized return, and then that also frees up your debt so that if markets do happen to dip down, you have that opportunity to buy back in, and it does keep you at a lower margin percentage. So as we started this portfolio, I basically wrote down on a little sticky note, I have it on the corner of my filing cabinet here with different milestones and unrealized gains. So if you click, just show you guys a quick little tip here. If you're on Wealthsimple, you can click on this text here. It's going to be green or red depending on where your portfolio is, hopefully green. But you can click on this text here and it'll show you guys some performance insights of your account. So you can see different things like your all-time return. The big one you want to pay attention here is to unrealized returns. So this is going to be your stock growth, right? This is your unrealized returns, and this is really important in a margin account because anything could change. You know, that realized return could go to zero. And with margin, we're borrowing money. We're taking money that we didn't have and we're investing it to make money. So we're not trying to be greedy here. We're not trying to get the max return. We're kind of trimming things as we go. And again, like I said, it gives you a realized return, gives you actual cash. It pays off your debt, pays off your loan. You'll pay less interest. And it also allows you to have more deployable debt that you can use if markets do drop down. So that's the cool thing about it. And like I said, I wrote down, so when we hit $50 in unrealized gains, we sold off a little bit. About $25. When we hit $100, I think we sold off another like $30. When we hit $150, my next goal is to sell off $50, and then so forth and so forth. And every single jump up is going to be a little bit higher. And so eventually we'll get to the point where we won't be selling so much when the portfolio has a lower amount. It'll be more like, hey, we hit $500, let's sell off $100 or $200. Hey, we hit $1,000, let's sell off $300. It'll be a little bit more higher, but the idea here is just to practice trimming, get into the habit of it, and also get some quick wins because the market is going up, so we can take advantage of that. But you can see your all-time return here. You can see your net deposits, so that's that $50 I was talking about. You can see unrealized returns. Right now we have $130 in unrealized returns. Once the unrealized returns hits $150, I'm going to be selling $50 off, and then that now will be taken off the debt of the loan, and then we'll just reinvest it back into stocks inside the same portfolio. And I'm going to keep everything inside the margin account so we can track everything. And oh, sorry, my cat's messing up my computer screen here. So we can track everything here, and you guys can see it all in one place. So that's the goal with that. And if we scroll down here, we can see the stocks we sold. We can see realized return here. We have $43 Canadian. We can see the tickers like VFE, VDY, and HDIV. And hopefully, guys, you can see the dividends earned all times. So that's about $7 or so, again, from HDIV and VDY. So that's a way you can track it, and you can see your realized returns. So once again, this is going to be stocks that we've sold for capital gains. And these are like the previous trims I did. We sold VFE and VDY. The big ones we're going to be selling is going to be our big ETFs. So the covered calls we're not going to be selling, so we can delay the return of capital. When we talk about taxes and different things like that, we'll kind of go into that. It's a little bit more advanced stuff, but again, we're focusing on selling some of the more growth ones, keeping the covered call ETFs to pay off the interest and the return of capital to delay that. And yeah, that just keeps the dividend income side of the engine rolling, and then we can deploy our capital growth in and out kind of as we see fit. So here's the stocks we have. I did add a few more stocks inside the margin account. I think I talked about allocation in the previous video. We're going to kind of more or less keep the same with a few tweaks here and there. Obviously, when you go in margin, what you're going to be buying is going to be based upon what's down for the day. So my goal is to basically buy anything that is down for the day. So whenever like this morning, for example, I logged into my account and everything was green except for HHIS. I think HHIS was down like 0.65%. So I check first thing in the morning, I bought a couple shares, and then I check at the end of the day. And if everything's green, I just leave it. If it's red, I buy whatever is red. And I buy based upon how much it is down. So if VFE is down, like, let's say it's up 0.58% today, but let's say it was down like 0.2%, and I'm going to buy $300 per day max, I might buy like $100. Let's say it goes down to 0.5% negative. Maybe I'll put $200. Let's say it's down a whole percentage point. Maybe I'll go $300. Maybe I'll go a little bit more if I feel like it's an opportunity. So, but more or less, I'm trying to stick to that $300 per day thing, but I'm deploying it slowly over time so that I'm not using up all my margin at once. It also allows you to pay a lower interest rate because remember, your interest rate is based off your daily debt balance. So if you deploy your margin slowly over time, that interest is slowly going to grow. If you deploy $5,000 in debt right now, starting to the day you do it, you're paying $5,000 of interest. But if you put like $300 a day, the first day you pay $300 of interest, the second day $600, and et cetera, et cetera. So that's a nice little hack that you can kind of delay the interest a little bit. And you'll see that when you buy your dividend stocks like CDA, HDIV, HHIS, VDY, VFV, XCI, these all pay dividends. You don't have to hold the stocks for the entire 30 days to get the dividends. You just have to buy them before the ex-dividend date. So again, these are little hacks we'll talk about as we go, but you'll naturally be able to pay less interest this way, especially when you make a trim. So if I trim off let's say I trimmed off like let's say I want to trim off $50 and I had to trim off like $1,500 from the debt, I now will have to pay less, that $1,500 less daily in debt, but I still keep the bulk of my dividends coming in here. So like the idea is to get those dividends compounding and growing. And if you can buy stocks when they dip, you also get a higher yield of cost. So we'll start to see that kind of unroll as the portfolio goes, but I try very hard to stick to this. It's very difficult when you see markets going up right now. It's very tempted to be like, oh, I could buy some VFE because like, hey, it's been up whatever it is for the past, let's say the past week here. Let's say it's been 0.7%. Let's check the last month. This is a better example. 0.3%. So maybe we think it's going to go up more, but like the reality is you have to try the best you can to stick to your rules. And my rule here is to only buy on dip days. Only buy dip days. And I think yesterday was a bit of a dip. So I did buy some shares yesterday, but today, completely green day. The only stock was HHIS. And what I do with the covered call ETFs, because they only represent about 30% of my margin portfolio, I just buy less. So you can see here I have a fair bit of HHIS. I have a lot of HDIV and not so much CDA, but because these are higher allocations and I want to bring these up more because when I trim them, it kind of messed up the allocation a little bit. That naturally just happens. Because of that reason, if there's a buying opportunity for HHIS, I'll just buy less. So like today when it was down a whole percentage point, I just bought $25 so that my VFV and VDY and XCI and all that can catch up over time. So that's kind of the way I do it. Again, you're going to never be 100% perfect, but you guys can see the different prices here. So like today's price was a pretty good green day, and then you can see the all-time return. So CDA is up 1%, HDIV is up 5.67%, HHIS is up 0.46%, VDY 4%, VFV 2%, and XCI 1.73%. And again, this portfolio is brand new. And again, buying the dips allows you to kind of, capitalize on some of the ups and downs and whatnot. And I found it to be very effective because it's very important for margin that you try to keep your account in the green, and the buying the dips help you do that. If it was my regular account, my TFSA here, you guys know my TFSA that I have here, my main accounts, I just buy no matter what. Don't think about it. I'm not trying to time the market. You make more money just by putting your money in and not worrying about it. But with margin, you got interest rates, you got the real risk of markets dropping and getting margin called. But you also run the risk of if you use too much, you're not going to have the money available to capitalize when markets do drop. So you always kind of want to keep that buffer open. And that's another reason why I'm doing this slowly. So that's a quick little recap there. I don't think there's anything else I want to talk about other than the dividends. So all the dividends that we are getting from the account here, and I think this is worth mentioning, is that all these dividends here, so like the $7 we got last month from HDIV and VDY, and I think we get $1 or $2 from XCI this month. I think it's going to be coming up in the next couple days. All those dividends automatically go towards the debt here. So you see this margin used, dividends will automatically repay that down. That's the way it works with Wealthsimple. Same with capital gains. So if I sold and I made $100 or I took out $50, when my unrealized gains goes to 150 and I take out $50, that'll automatically go to paying off the debt. It just gets subtracted. So that obviously helps your interest rate, and it's just like that. So that's the goal here, and that's why we have the dividend redeployment. With the dividend stocks, they do pay throughout the month. Again, interest only gets charged once per month, kind of at the end of the month, or the beginning of the month for the previous month, right? So as we get dividends from CDA, it pays out twice a month, we can kind of slowly pay off that interest throughout the month. And then by the time you pay the interest, it's going to be a little bit less. Again, it's nothing major. It's not going to make a super big difference, but it will help you guys out. And it's very psychologically beneficial, right? Because like we get dividends almost on a weekly, bi-weekly basis, and that just goes towards paying off that debt. Feels good, right? So that's another approach here. But let's jump inside the spreadsheet and I'll give you guys a quick little update on how that's been doing. All right, so here's the margin spreadsheet. It's pretty simple. It's pretty basic. There's nothing fancy. Let me know if there's anything you guys want to see here that I haven't included. This is just really basic. I just want to do some basic tracking. So again, the idea here is to just track things and see how we're doing, see how things are going, because it can be a little bit confusing, especially with margin. And again, I want to kind of show the strategy here. So actually, one thing I can also show you guys as well is the yield on cost and whatnot, which I'll show you guys, I guess, in the next part of the video. I'll give you guys an update on that as well. So let's cover this really quickly. So we have the TFSA here. This isn't updated. I don't think I updated it today because the markets have gone on. Our margin used is a little bit higher than this. I think I did this a couple days ago. So as you guys can see, I did have some opportunities to buy because we're at 3,762. So I did have a couple red days this week. So I did buy some stocks, as you guys can see here. So we're not a little bit higher than that. It's closer to like 2% or so. Again, our max is 7%. Realized return is $43. So that's how much money we've made. We paid off the debt, plus $43 since we've been doing this count for, I think, give or take a month or so. We're almost on to month number 2. Or a month and a half, whatever it is. And our total gain, which is returns plus dividends, is $47.94. So about $48 in total we've made off the portfolio. And we've paid off the debt. So over time, eventually the portfolio will fund itself and we'll have less and less debt and be able to grow it. September here, I have September, October, nothing has happened yet. So we started this account, I think, in mid-August. So as we invested the portfolio at the beginning of September, we paid the interest for September. We will pay the interest for September at the beginning of October. So we kind of get the dividends after the interest. So the way I look at it is like, oh, we paid interest in September and then our September dividends was $7. Therefore, we had a net profit of $4.40. And the reason why we have a profit here is because I'm targeting about a 6% yield with the covered call ETFs and the high yield funds. That's why they're there. They're there to pay off the interest and even more. So that benefits us. So we got $4 gain in dividends. So even the dividends alone, yet alone the capital gain, the margin account is doing well. Now, obviously, markets are doing well right now, so that's why we're seeing that capital growth. But even if markets were falling down, the dividends would still cover the interest. Therefore, we're not rolling up the debt because that can be a big problem, especially if you have a growth-based portfolio in your margin investing. That debt can really snowball and get a little bit out of control. And the nice thing about the dividends this way is I don't have to worry about the interest. The interest is covered and more. I just have to worry about the capital gains. So when I look at my portfolio and I see like, oh, we're green here, 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 I don't have to worry about anything else. So that's another reason why I did that, for that benefit, for the compounding growth, to pay off that debt every single month. We're always paying off that debt no matter what. Even if markets drop, we're paying off the debt, right? And that's the whole purpose there. So first month, obviously not big numbers, pretty small. October is going to be a little bit more in terms of interest. I'm estimated about $12 or so we're going to pay in interest, give or take, and our dividends are going to be, I think, about $22 to $25, maybe even more, because remember, there's a lag. Our October interest is going to be basically paid, charged for us at the beginning of October, but we're going to keep putting money into the accounts. We're going to keep growing those stocks, and then that's going to grow our dividends up for the end of the month as well. So that's why you get that kind of spread there. Especially if, like I mentioned, you are redeploying and kind of adjusting the debt over time. So that's why we're doing it that way. Again, guys, I know this is a lot of stuff to talk about. We're going to try and dumb this down and make this as simple as possible. In every single video, we're going to highlight some different things. But again, these first couple of videos are just going to be a basic overview of the strategy here and allow you guys to see how things work. Because remember, we can talk about it, we can read books, we can research the stuff, but unless you kind of see it and you see the way markets go and you feel it, that's how you kind of really learn from this stuff. And that's why I've always done these videos like this. So our yield and yield of cost, I'm actually going to give you guys a quick update because I did update this on Track Your Dividend. So let's jump over there and we'll do a quick little overview of that. All right, guys, so here's the Track Your Dividend sheet. This is basically a way for me to track the margin account. I manually update this every couple days or so. I probably will eventually do it less, but I just updated it the other day. So here's our portfolio yield. As we can see, it's a little bit higher than normal. This is because my allocation is just a little bit off, but even so, we've already see a positive yield of cost. And again, this is buying during the dips, but also the market kind of growing the past little bit. So it's our yield of cost is always going to be spreading, and we can see our annual income here, which is pretty cool. So we're already making $281 in terms of annual income. And here's the individual stocks as well. You guys can see like the stocks, the tickers I bought. I didn't include C-Day here because for some reason, because it's a new fund, I think it's getting screwed up with some other pricing and reporting. So unfortunately, I kind of took it out of here because it wasn't reporting accurately. So C-Day is not in here quite yet, so that's not represented, but it's a small holding anyway, so I'm not too worried about it. Over time, it'll grow. But we can see the dividend yields of each individual stock and the yield on cost and stuff like that. So again, just a quick little update for you guys. Nothing major. Like I said, I think the biggest fund that's been doing the best for us is HDIV, but it's also because this is the one we're going to hold long term. As we sell off some shares in VDY, VFB, and XCI, naturally the return is going to be a little bit less, but also those funds have the most capital growth potential. So we will be selling them and holding them. And the cool thing about this portfolio is you do get a mix of everything, right? We have about 70%, we have about 30% or so of good solid growth, 30% of dividends plus growth, and another 30% for income. So it's a nice little mix and it covers all things. And I think it's very conservative, and especially with the 7% margin cap, it really works really, really well. And again, there's flexibility. So like if the markets did go down like 20%, if we wanted to bump that up like 1 or 2, 3 percentage points, we could. So yeah, that's the strategy there, guys. Once again, I know this is a lot to take in, but let me know what you guys think. If you guys have any questions, let me know in the comments. I'll try to get back to you guys as quickly as possible. And again, these updates will probably be, once a month or so. I think it's going to be the way we're going to do it. But anyways, guys, hope you guys enjoyed the video. Take care. Have yourself a good one, and I'll see you guys later.